Good morning. My name is Uday Turaga and I'm with ADI Analytics. Welcome to our weekly webinar series. We're going to talk about industrials and OEMs this morning and how this particular segment of companies can prepare for the current downturn that we are in. For those of you who don't know us, ADI is a boutique consulting firm focused on oil and gas, energy and chemical markets. Within these markets, we work across the value chain. So if you take oil and gas, we work in upstream, midstream, and downstream segments. And similarly, in some of the other markets, oil and gas, as well as energy and chemicals, we have supported segments across the entire value chain. Within these market segments, we work for a broad range of companies. We do a lot of work with the operating companies, the likes of the large oil and gas majors, the refining and E&P independents, as well as the chemical companies. But we also support a number of companies that sell equipment and services. So the industrials and the OEMs that serve these market segments, we have also done a lot of work for those companies. And then finally, we've supported a number of investors, private equity and venture capital, as well as early stage technology companies in the oil and gas, energy and chemical market. We are helping clients with a number of questions concerning the current market situation. Some specific ways in which we are helping clients are listed here. But very briefly, we can help companies identify the right customer and market segments that they should be focused on in this current environment. Market segments that are still active, that are still seeing capital spending, for example, and identifying those segments as critical. We can help clients with reorienting their offering mix and value propositions in the current environment. Clearly, cost reduction is a big area of focus, and we're helping clients currently with understanding their cost structure and figuring out strategies to further optimize cost structure and competitiveness in this environment. And then finally, companies that are looking for growth opportunities. There's a fairly good time with attractive valuations, and we're helping in particular a number of private equity firms with due diligence and support around various transactions. Moving on, I'm joined by my colleague Brandon Johnson this morning. We'll have a short Q&A, kind of a roundtable discussion at the end of the presentation. Meanwhile, I'll start off by sharing some insights that we see in the market today. Clearly, OEMs and industrial companies have begun responding to the changes that we are seeing in the oil and gas, chemical and energy markets. If you look at the areas that public OEMs are focusing on based on conversations during earnings calls, we see significant changes. Over the last 90 days, the agenda that public OEMs are focusing on has changed quite dramatically. Some of that is shown on this particular page here. Remote maintenance services are some examples of the renewed focus on aftermarket in general. In terms of commercial strategies, we see a lot of interest in price discounts as well as marketing strategies. In digital, there's been some interest around remote monitoring capabilities. We don't quite see as much of an interest or uptake in some of the other digital offerings, let's say around machine learning or artificial intelligence. In terms of innovation, some of the disruptions in supply chains that we have seen has led to a significant growth in and interest around additive manufacturing and fabrication capability. Outsourcing and cost-effective best-in-class, best cost supply chains is clearly of lesser interest in this environment, where reshoring is what a lot of operators, a lot of industrials and OEMs are instead focused on. Similarly, R&D, innovation, and product management has declined in terms of focus with some of the larger public OEMs. We'll talk about some of this in a little bit more detail here as we move along, but uh, when we start thinking about response strategies in the current environment for OEMs and industrials, based on our conversations with players in the space, as well as some of the work that we have been working on over the last 4 to 6 weeks, we see a couple of ways in which OEMs can approach this particular downturn. One is a more near-term focused strategy, and how can OEMs and industrials prepare in the near term. We'll share some specific ideas that we are learning from our work serving OEMs and industrials. And then finally, there's a medium-term set of questions that need to be answered and strategies developed for the medium term, which is focused on how OEMs and industrial players can prepare for the next couple of years, ranging anywhere from 4 to 12 quarters is the focus that we have been thinking of. So in terms of near-term strategies, clearly building a granular picture of the CapEx and customer landscape is a good first step. We see a lot of interest amongst our clients. Over the last 10 years, we've supported a number of equipment and service suppliers into the oil and gas, energy and chemical markets. And as we look at some of these clients' approaches in this current environment, one strategy that we are recommending to all of them is understanding at a very granular level, what does the CapEx and customer landscape look like going forward? We know that a number of large oil and gas operators, as well as smaller players within the oil and gas, as well as the chemical industries, have cut capital spending pretty significantly. This chart here shows capital spending reductions announced by US oil and gas producers in the first quarter of this year. This is all upstream focused capital spending. And over $30 billion of capital cost reductions have been announced by upstream oil and gas producers in the first quarter. We have seen similar CapEx reductions by midstream companies. Some of the downstream players, refiners, have also cut CapEx in response to the current downturn. So clearly across the board, we see a significant reduction in capital spending. But there are a number of operators who are still fairly well positioned in terms of either hedging and contracts for their production and therefore continue to spend capital, as well as are well positioned in more broader terms in terms of liquidity, as well as fairly robust long-term growth strategies. These are usually operators that have assets at the lower end of the supply cost curve, or these are operators, for example, who are operating at some of the best shale plays, or are sitting on projects that are well capitalized, for example, midstream projects that are either well capitalized or are well positioned in terms of long-term take-or-pay contracts. So understanding who these operators are and segmenting the market very carefully in terms of identifying where capital spending is going to still be active, and targeting those particular market segments or those particular customer landscapes is one way in which OEMs and industrials can better define their near-term market-focused strategies. A couple of other ideas, focusing on opportunities where an OEM's offering is particularly differentiated is going to be a more productive approach in this environment, as opposed to, let's say, trying to find new market segments where they're trying to introduce a particular offering. Similarly, understanding the value proposition of offerings and how customers see that value proposition, and adjusting messaging and marketing around a deeper insight into the value proposition from the eyes or from the lens of a customer is a good way to focus and drive your marketing campaigns in this environment. So we've done a lot of voice of customer research for OEMs in particular and industrial players, both around equipment offerings and service offerings. And doing similar voice of customer research is an effective way to better understand how customers perceive a particular set of offerings, what kind of differentiation is evident from a customer's point of view around an offering or a product, and honing in marketing and messaging strategies around that customer perception around the value proposition is going to be a very productive approach in this particular environment. So what we have on this page here is output from a voice of customer study that we did around for a compressor OEM. We went and interviewed a bunch of operators, midstream operators in particular, and asked them about their interest in certain attributes, whether it is speed to market, vendor relationships, cost and pricing, overall vendor reputation, the capability to provide aftermarket services, and then finally around technology leadership. And then we did cluster analysis to identify which of these capabilities or attributes was most favored by customers on a global basis, specifically to North America or specifically to international markets. And based on this, we provided input to our client to either identify capabilities where they can further reinforce their leadership presence, or identify messaging or other marketing collateral that can further drive or reinforce a particular capability of theirs. Now, of course, there's a lot more benefit that you can squeeze out of similar voice of customer research. One of that is guidance on your product management and product innovation roadmaps. This voice of customer insight can be very helpful in defining what kinds of products or features that the market really value, and either developing new offerings or capabilities that enhance offerings around those specific customer needs is a good effective way to shape your innovation roadmaps. Finally, pricing and discounting is definitely going to be a critical commercial topic for OEMs and industrials as they negotiate sales and contracts in this particular environment. We see that already in earnings transcripts, and that's a big change over the last 90 days. Discounting and marketing has become a key item of conversation within the C-suite, as well as within conversations with the investor community. However, this has to be approached in a fairly thoughtful fashion because it's very hard to recover from price discounts and takes a long period of time. So if you look at the last financial crisis in 2008-09 timeframe, this is a chart that shows OECD producer price indices. And you can see that producer prices fell by about 10%, a little short of 10% within a quarter or two during the last financial crisis. But it took almost 8 quarters or 2 years for the pricing to recover back again to the prior to the beginning of the recession. So that's a fairly long time frame in which operators and companies have in order to recover pricing. So before offering discounts or significant changes to pricing strategies, it's important to kind of gather intelligence, pricing intelligence and market intelligence on a real-time basis to drive some of these price and discounting strategies. So let's switch gears a little bit and talk a little bit about medium-term strategies. So these are strategies that will help OEMs prepare for anywhere from the next 4 to 12 quarters. Clearly, we saw some of the interest in aftermarket services, but beefing up that aftermarket business is a good approach to drive near-term revenue growth for OEMs and industrials. Again, if you look at some examples from prior downturns, this is an example of sanitized example of market size for engineered pumps during the last oil and gas downturns that started in late 14 and went through the end of 15, early part of 2016. You will see that there was a significant decline in the share of original equipment sales for the overall engineered pump business. In comparison, the overall share of aftermarket services was fairly stable. Of course, the overall market size fell, and as a result, the share of aftermarket services in absolute revenue terms also went down, but the reduction was much smaller in comparison to what we saw for engineered pumps on an original equipment basis. Now, in addition to building that aftermarket business, there are other strategies that OEMs can think about. Specifically, this is reevaluating target market segments and focusing again on market segments where there's a very clear differentiated fit. Also doing additional work in terms of understanding which target segments should they be focusing on in terms of aftermarket services is a good approach in this environment. Not all customer segments are going to value an OEM-driven aftermarket strategy or an OEM-driven aftermarket service offering, and identifying appropriate target market segments which will be willing to provide a premium that OEMs typically charge for their aftermarket services, and focusing on those target segments is particularly important. Again, this is a particularly good time if companies are well positioned from a liquidity standpoint to pursue M&A. Valuations are clearly very attractive in this particular environment, and this is particularly relevant, especially if companies are trying to grow their aftermarket service footprint. The aftermarket service footprint is usually fairly fragmented, and this is a good time to kind of go and acquire a lot of players in that space. Similarly, integrating a lot of these aftermarket service offerings in the entire range of offerings within a particular OEM or industrial might offer, and bringing that life cycle approach towards product sales and revenue streams requires significant changes in both the cultural mindset as well as the way in which some of these offerings are made available to the market. So tweaking that go-to-market strategy is a particularly productive use of time in this particular environment. What we see is that companies that have integrated a lot of these strategies in their response tend to talk more about their maintenance service offerings in their earnings disclosures, and as a result, that leads to a slightly differentiated performance in terms of total shareholder returns in public markets. Digitalization is definitely a big area of focus. Of course, we at ADI think that this is a buzzword that has been overhyped pretty significantly, and instead we believe that a more thoughtful approach to digital tools and services is prudent, but it's a way to differentiate a particular set of offerings in the market, and it's something that needs to be thought through a lot more strategically before making big investments. What we have seen is that companies that are focused on remote monitoring and remote maintenance are talking a lot about these in their earnings disclosures, and that is, again, allowing them to differentiate themselves in public markets. Finally, refocusing innovation, in particular around functional capabilities, is a prudent approach in this particular environment. So in general, if you look at public OEMs, they have started to de-emphasize innovation, R&D, and product development capabilities as their areas of focus. But there are certain select areas, additive fabrication is one good example here, which is becoming important, especially as supply chains have gotten disrupted and there are other drivers in the market. In general, the 3D printing additive fabrication market is growing rapidly. It's growing almost at a CAGR of over 20%. We expect that growth to be fairly significant and more than doubling the market over the next few years. And there are a number of drivers for this. We talked about supply chain disruptions, but also the manufacturing flexibility that comes in from 3D printing and additive fabrication capabilities is important. And then finally, as interest in circular economies and waste reduction grows, additive fabrication is going to become an important strategy. Finally, the interest is shifting towards reshoring and localized supply chains. And as a result, we don't see a lot of discussion out there in terms of best in class or best cost supply chains or around outsourcing. And we expect this trend to continue for the next few years. So with that, let me bring in Brandon in this conversation. Brandon Johnson's been with ADI for 5 years. He's a senior colleague of ours, has worked on a number of OEM projects over the last few years. So Brandon, while we await some questions in the chat box that attendees can send us, here are some questions that we have been thinking about internally. And maybe we can get started with that. So Brandon, we've done a little bit of work looking at which segments are likely to recover faster and how should OEMs be thinking about this, you know? So I guess, what are we seeing that would suggest that there are particular segments that OEMs should be focusing on in this environment?
Okay, I can think of about 3 segments that are likely to recover the fastest. And that being downstream, so that's petrochemical and refining markets, gas, and segments focused on decarbonization. Focused on downstream, although operators have clamped down on a lot of their routine maintenance scheduling, turnaround projects will still likely go on as planned, even if they've been delayed about 2 or 3 months from what I've been hearing. Gas markets will also quickly recover as associated gas supplies decline. This will cause gas prices to increase, which we've already been seeing. This will likely lead to some capital investments in gas infrastructure. And lastly, focus on decarbonization. And this includes hydrogen, biofuels, carbon capture and storage. We will likely see some growth there and some fast recovery due to a push for decarbonization. And focusing on that, even if you look at the Bakken, they've had a decline, I think, of about 40 oil rigs or so. 2 of those oil rigs have been repurposed actually to drill test wells for carbon capture and storage projects. So not only has there not been a significant decline in activity in carbon capture and storage, there's actually been an increase in activity there.
Mm-hmm. That's very helpful, Brandon. You know, one of the things that we have been doing some research on is this question on how OEMs and industrials are actually responding around manufacturing operations, especially in this recovery phase. And what we are seeing is that different OEMs and industrials all have different approaches to this, but at a high level, we see a couple of key trends. First, I think there's a greater focus on bringing supply chains back on stream so that they can start manufacturing and delivering products into different into their customer value chains. Second, there's been a lot of emphasis in making sure that people are safe and are able to execute all of their work either remotely or through the use of fairly safe manufacturing and operational practices. So we've seen quite a bit of emphasis and investment and resourcing in those areas. And then finally, we are seeing from a manufacturing and operations point of view, greater interest in the use of digital tools and technologies. Clearly, a number of these tools and technologies that were in pilot phase are now being accelerated for commercial deployment, especially as OEMs and industrials try to address manufacturing and operations in the age of, social distancing. So, given that, Brandon, you've been doing quite a bit of research in digital. How is adoption in digital looking like?
So in hindsight, it's easy to see how digital solutions such as remote monitoring, digital twins, and like remote asset management tools could have helped operators ensure some sort of business continuity during the early stages of this pandemic, at least. So Shell, for instance, noted that some investments that they've made in digital transformation has actually reduced the impacts of COVID-19 in terms of their operations. They've cited, smart meters, digitizing processes, and remote monitoring. But overall, this likely won't spur an increase in digital adoption in the near term, as most operators have cut CapEx and have canceled many of their short-term projects. And even though that's the case, many have retained their long-term targets, especially focused on digital transformation. If you look at Total, for instance, they recently essentially doubled down on their commitment for digital transformation, even after reducing their CapEx outlook for this year of about 3.3 billion. So I think it will be impacted in the near term, but for long term, those commitments seem to still be in place. I guess I'll wrap up here with a few more comments from our research. In about 2015 or 2016, me and Uday both wrote an article basically focused on the downturn at that time, looking at how OEMs can compete in the downturn. And while this situation seems to be significantly different from that event in 2014 and 15, some of the takeaways are still the same in terms of how OEMs can react and stay afloat during this downturn. As Uday mentioned, focusing on aftermarket services, whether that's replacement parts or maintaining existing equipment, would be a huge asset, especially for operators as they're looking for near-term solutions and cheaper solutions such as maintenance and not necessarily equipment replacements. And additional things that OEMs can do is bundling services. So OEMs who are supplying pumps may also supply valves or things such as that nature, and bundling those services. Or like we've seen in 2015, some OEMs were essentially giving away equipment just so they can ensure those aftermarket and maintenance contracts. And just speaking with a few OEMs, some of them are going back to the same methods that they used during that time period.